Hello, everyone. Can everybody hear me okay in the back? Good? All right. We're going to get rolling here to try to keep us on schedule. So I'm going to start off with a confession for today. Last night after dinner, I raided my son's Halloween candy from last week. So while that's not anything, and it's not the first time I've done that, and will probably happen again later, after that, let me start. First, I raided his candy for this Kit Kat bar here. King-size Kit Kat bar, so I brought that in. But then after that, I got a little more risky, and I raided my wife's baking shelf for these Hershey Kisses for the day, to help with props for my presentation. So you can see from my bio, I live up in Cranberry Township, so after today's presentation, I have about a probably 45-minute or hour ride home with traffic, so there's a good chance that these aren't going to make it home. I'm going to be in a lot of trouble when I get home, so just wanted to confess right off the beginning, so we start on equal ground here. So Mike Weber and I are going to speak about state tax issues today. We're going to spend a majority of our conversation discussing sales tax matters. There's been a pretty significant development that occurred this year with regard to that, so Mike's going to kind of cover that case. But I wanted to start off with just kind of doing a kind of a general discussion on sales and use tax to make sure everyone kind of has a good understanding. So with last week being Halloween, I want to do a quick poll, show of hands. How many people feel that Hershey Kisses that were bought and the Kit Kats bought last week and passed around were subject to Pennsylvania sales and use tax? Just a quick raise of hand. I don't know if anybody checked their receipts when they bought that. Anybody feel like those were subject to sales tax? A couple hands. Okay, how about the opposite? Who feels that these were exempt from Pennsylvania state sales tax? All right, more hands. All right, trick question. I'll give you a third question. How many thinks that maybe there's a difference between these two items on the screen with regard to them being subject to sales tax? Oh, I thought I'd get a lot of hands there. People figuring I had a reason for picking these two items. Well, let me start by saying, I went ahead too fast there. Generally, candy is an item that is considered a taxable good by most states, including Pennsylvania. But just a quick I brought in what the definition of candy is according to the Streamlined Sales Tax Governing Board, which that's an organization that they work to try to merge all the different state sales and use tax rules and at least get consistent approaches as best they can. Not all the states follow it, but most do. They go on to define candy as a preparation of sugar, honey, other natural and artificial sweeteners in combination with chocolate, fruits, nuts, and other ingredients or flavors in the form of bars, drops, and pieces. It goes on to say, candy shall not include any preparation containing flour and shall not be refrigerated, and shall not need to be refrigerated. Well, if you look at the ingredients on the Kit Kat bar, the second ingredient on here is actually flour. So based off Pennsylvania and many states' rules, technically Kit Kat is not a piece of candy. So Kit Kat's not subject to sales tax. However, the Hershey Kisses, because they don't have flour, are subject to state income tax. A couple other things, Twizzlers you would think are generally candy. Those have flour in them as well, so they're not considered a candy. And actually Milky Ways used to have flour in them, so they were exempt from tax, but then they changed their ingredients a few years ago, and so now they're a taxable item. So you can begin to see what I'm trying to make a point here is how kind of just the change in small details can change the taxability of something. Let's go on to another sweet treat, being marshmallows. You would think these would have similar, common sense would say these would be taxed in a similar way. However, most states actually, define the big marshmallows and the small marshmallows to be candy as well. So they tax those types of items. While marshmallow fluff, because of the way it's sold and the consistency of it and put together, it's considered a grocery item. It's not a prepared food, and therefore it's exempt from tax. New York actually, for a while, differentiated between big and little marshmallows. So they actually would tax one but not the other. And after a while, they got a lot of pushback and they realized how ridiculous that is, so they have a common taxation of those items. So let's look at breakfast items. Driving here today, if you stopped at Dunkin' Donuts and bought a couple donuts, generally if you buy food at a grocery store, those types of things, those are not subject to taxation. However, if you buy food that's prepared for you from a ready-to-eat type establishment like restaurants and so forth, you obviously get charged sales tax on those items. Well, Dunkin' Donuts, you buy 2 donuts, it's considered a prepared food, you pay tax on it. However, if you go into a grocery store, Giant Eagle, and buy a dozen donuts, those are considered groceries you're bringing home, not subject to tax. You stop at Dunkin' Donuts and pick up a dozen donuts for your daughter's soccer game. I think generally those will not be subject to taxation, although there's been some controversy with that. But again, there's a gray area. How many donuts do you have to buy before all of a sudden it's not subject to tax? Is it 5? Is it 6? It's just, again, there's a lot of inconsistency with regard to the states. Orange juice. In Pennsylvania, as long as the juice has more than 25% real juice in it, then it's exempt from tax. If it's less than 25%, then it's considered more like carbonated beverages and the like, and therefore subject to the tax. So, last example is hygiene items. You look on the screen, you think, well, these items look pretty similar, they should have similar treatment. Well, generally deodorant in and of itself is the taxable item in most states. However, a lot of states, just by adding antiperspirant to it, having a combination of it, that's enough to make it all of a sudden a tax-exempt item. And also with regard to toothpaste, toothbrushes, those things are tax-exempt. However, mouthwash is a taxable item. So it's just, again, demonstrating how just the slightest change in detail with regard to how the state taxes items can determine whether a piece of tangible piece of property that you're selling, a product, is subject to state tax or not. So kind of setting the stage there, let me back up just a little bit and kind of do a general overview of the state sales and use tax. We'll talk mainly about Pennsylvania, but cover kind of some general items with regard to states as well. So we know that sales tax is generally a tax that's on a transaction, right? A transaction has to occur in which there's a taxable exchange. Well, in that situation, it's actually a consumer tax. So the buyer of the product is the one that's technically responsible for the liability. Now that's important because even though the buyer is responsible for the tax, most states, including Pennsylvania, put the onus on the seller to actually collect and remit that tax on behalf of the buyer. So in situations where where a seller does not properly collect and remit the tax, the state actually has the authority to come in, hold them accountable for the tax they didn't withhold, and force them to pay the tax. So it ends up having a business paying a tax for a liability that wasn't theirs unless they have the ability to somehow go back and collect that liability. So once a business has, makes its taxable transaction, they have the obligation to collect and remit, they have this tax administration duty. So what's that involve? Well, as we talked about, it's determining, first of all, what services or products that we're selling are subject to taxation. We already looked at a dozen different items that were very hard to tell which is taxable, what's not taxable. You expand that to manufactured items and different types of services, you can begin to see how complicated and complex this is. The sale of tangible personal property generally is always deemed to be taxable unless there's a specific state statute that says it's non-taxable. And of course, services are the exact opposite. Services are generally deemed to be non-taxable unless there's a specific rule with the state saying that that's subject to tax. Now the problem there is most states have struggled to keep up with the evolving business economy, and as services continue to be performed online, on the cloud, those types of things, and become more computer-type services, they've struggled to kind of keep up with definitions of what are taxable services. So they continue to put out this guidance trying to let taxpayers have a general understanding of what type of computer services are taxable and what aren't. But at the end of the day, there's a lot of interpretation involved in determining what is truly a taxable service and what isn't. If you have a taxable sale, there's also what's called exemption certificates out there. The two most well-known exemptions are an exemption if you're going to resell a product or if you're going to use that product in some exempt way, which the most popular one is in manufacturing that we see. So if a business is selling a product to someone that is claiming an exemption under either of these exemptions, as long as they collect a valid certificate, they're not required to actually collect the tax and remit it to the state. But again, the onus is on them to make sure they're collecting a valid certificate. If they get audited and the auditor comes in and determine that the certificate they received for whatever reason isn't valid, again, they can come back and assess that tax on the seller. And obviously, with any type of administration, there's a significant amount of registration and filing requirements that come with the particular states that you have a that you have a touch with, or what's called nexus with the requirement to file within the state. And then the challenge is staying current on all the developments and so forth with regard to the state. So wanted to present kind of a brief overview of the taxation of products and determining what's taxable and when you have a filing requirement. Mike's going to pick it up here and talk a little bit about the change that happened this year with regard to a state's ability to subject a taxpayer to their tax.
Well, thanks, Shawn, for that unique breakdown of what's taxable. Interestingly enough, my wife asked me right before Halloween, hey, could you stop at Walmart and pick up Halloween candy this year? So I did, and of course, what did I buy? Kit Kats. She comes home, I come home, and she says, well, why'd you buy Kit Kats this year? I said, well, it was cheaper because they have flour in it. I don't have to pay sales tax.
That's right.
So we've always given away 3 Musketeer bars. Not anymore at the Weber household. It's not often that you turn on one of the, news networks and see them breaking down a U.S. Supreme Court case that deals with taxation, and more specifically, sales tax. But if you watched any of the major channels in June of this year, you would have seen them discussing at length the Wayfair decision. I've purchased items off Wayfair. I think it's a pretty, interesting website, and perhaps some of you in the audience have purchased items from them. But, before we get into the breakdown of exactly what this case is all about, it's really important to understand, where we've come from to again, better understand where we're headed. But, I thought this was kind of interesting, right? We have a sales tax, and I guess at a broader spectrum, a taxation case. And look at the date up here. The Supreme Court gets to decide when these cases are going to be argued before them. And look at the date that they argued this case, April 17th. I could just imagine, right? You've got some law clerks sitting around the Supreme Court saying, wouldn't this be some type of poetic justice if we could have everybody who's bogged down with trying to prepare their own tax return, the experts in taxation, have to come before the U.S. Supreme Court on April 17th. So I imagine the litigators in that case are probably not too happy that they had to appear right on tax day. Of course, they probably extend their returns so they don't have to worry about it. But this case, and really what I'm going to be talking about, is trying to assess whether you as a business have an obligation to register, charge, collect, and remit sales tax on any transaction via your presence within any one particular jurisdiction. This really doesn't have anything to do with whether any event in and of itself is a taxable event. It's only about whether you are required to collect the sales tax. Of course, we could do the analysis and break down this candy versus that candy, and that's all fine and well, but once you get to that determination of whether it's a taxable event, do you have an obligation to charge the customer sales tax? That's what this case is about. Okay, just to give you a sort of again, a broader indication of how unique this is, the U.S. Supreme Court gets about 7,000 petitions a year. And of course, everyone well knows they're not required to hear any one case, except for when you have a dispute between two states, they are required to hear that. So of course, what do they hear? About 100 to 150 cases each year. So they're really looking at the unique issues that this country is facing, and by and large, they thought sales tax was a unique issue this year. But more importantly, though, the U.S. Supreme Court is very reluctant to overturn their prior decisions. It's just like you arguing with your spouse, right? Are you really ever going to go back on the fact that, oh, I said point A, but now 20 years down the road, you know what? You were right. I suspect we don't want to find ourselves in that position. But here the U.S. Supreme Court found themselves there. And as you'll see, they've overturned in this Wayfair case a prior decision dating back to 1992. You very rarely see that. Now, just to give you an idea of some of the other cases that were on the docket around the time the sales tax case came to be, sports betting, right? Okay, we've all seen this in the news. You go down to Atlantic City, you can place a wager. It doesn't have to just be out in Nevada and Las Vegas. Voting rights issues, partisan gerrymandering, presidential travel bans, digital privacy, collective bargaining amongst unions, and, yes, sales tax. Okay, the original case in this area dates back all the way to 1967, and effectively you had a company that they were a resell mail order business, and they resold their product into a jurisdiction in which they weren't situated. And Illinois came in and said, well, yeah, we understand you're not situated here, but we still are going to require you to register, charge, collect, and remit sales tax on your transactions into Illinois. And they fought this all up to the Supreme Court, and the Supreme Court sided with the company saying, yeah, you don't have any type of presence in Illinois, therefore we can't require you to, or Illinois cannot require you to collect the tax. In this case, again, they had no employees, no property, no advertising. All their orders were done by common carrier. Okay, this company, they received no benefit by transacting business in Illinois. They weren't, availing themselves of the rules and the laws of Illinois. All they were doing is basically just selling their product into Illinois. Fast forward all the way to 1992, this was, before Wayfair, the leading case in the area of sales tax. And what this was an office supply company, believe it or not, that was selling their product into North Dakota, and they were situated, right on the border. And they did not have any physical presence in North Dakota, and of course the ruling that came out of this case was, in fact, that before a state can require you to register, charge, collect, and remit sales tax, you must first have a substantial physical presence in that state. And in the opinion here, right, what did they say? Well, this does not resolve market distortion. Okay? How are we looking at businesses that are situated in one jurisdiction versus businesses that are situated in the same jurisdiction but have a physical presence somewhere else? Okay, those outcomes are going to be different. This comes to serve as a judicially created tax shelter for businesses. Well, that's obvious, right? As long as you cut down your physical presence, you weren't required to charge sales tax. Thus, you've had an advantage against the local competitor. They went on to say it's artificial at its edges, it was made up, and it's unclear. Why do employees in buildings, why are they the only things that create substantial nexus? Questions we're still pondering to this day. Moving forward, this probably is the most interesting case with respect to prior to Wayfair, only because this was the case that really caused state legislatures to enact statutes that would end up being challenged before the U.S. Supreme Court. And this was an out-of-state company that was selling into Colorado, and as part of them selling into Colorado, Colorado required them to provide this piece of paper to their customers that said, we're not required to charge you sales tax, but if you wanted to report the use tax on your Colorado income tax return, here's the amount you should report. And they fought this tooth and nail all the way up to the U.S. Supreme Court. I'm going to just jump ahead. Oh, excuse me. And one of the concurring opinions here came from Justice Kennedy, who ended up writing the majority opinion in the Wayfair case. And look at what he said here. Look, the instant case does not raise this issue in a manner appropriate for the court to address it. It does provide, however, the means to note the importance of reconsidering doubtful authority. The legal system should find an appropriate case for this court to re-examine Quill and Bellis Hess, which is the cases I just talked about. So a lot of practitioners thought, aha, this is our chance to create some rule that will allow the U.S. Supreme Court to reconsider their holding in Quill, and that a physical presence is no longer going to be required for a state to require you to charge sales tax and thus remit it. So what happened here? We jump forward all the way to 2016. South Dakota enacts a statute that says, and I have a slide on this a little further, that if you have $100,000 in sales transactions into South Dakota this year, it's as if you have a physical presence in this state, and thus you're required to charge, collect, and remit the sales tax. So what did they do? They picked on these 3 or 4 conglomerates, but Systemax there, they actually settled with South Dakota before it made its way through their system, but Wayfair was the one that wanted to battle them on this. It made its way through the South Dakota system, and all of the courts in South Dakota, which they're required to do, said, yeah, look, there's nothing we can do here. There's this case on the books dating back to 1992 that says, unless you have a physical presence here, the state cannot require you to do and charge sales tax, so there's nothing we can do about this. But oddly enough here, why did they pick South Dakota? Well, a lot of practitioners think, well, it's because they had no income tax, so how could they generate revenue in South Dakota if they're not going to be able to collect the sales or the use tax that goes along with any of these transactions? Okay, so what did South Dakota have to say in this? Look, brick and mortar stores are being harmed. The physical presence requirement is flawed. There's only a 4% compliance rate with the use tax. So even though you purchase a product and someone doesn't charge sales tax, still required to report the use tax. Okay, we've kicked this around our office, right? And I pulled up the instructions to line 25 of the PA 40. Here's what it says. If you purchase items or services subject to sales tax for which the seller does not charge and collect sales tax on the invoice or receipt, you are personally responsible for remitting the use tax directly to the PA Department of Revenue. So if everyone could print out a page 2 of their PA 40, and let's figure out who here is reporting use tax on their PA 40. I suspect, they say it's a 4% compliance rate here. I suspect maybe it's even lower than that. Of course, South Dakota is saying, look, we're losing about $48 to $58 million a year as a result of the sales tax not being collected at the point of purchase. And if you add up all the states, it's about $8 to $33 billion annually. So what did Wayfair, what was their argument in this case? They said, well, of course, what did they rely on? Oh, well, I look at this case from 1992. Yeah, that's the reason we're here. That's probably not a great argument. They said, well, it's too high of a burden on companies to collect in each jurisdiction. Oh, put yourself in those shoes. You might, conclude the same thing. They said, well, we have to some places have to charge sales tax, but we have to charge shipping costs too. So they're about the same. So where's the advantage? And they were also very concerned, as most practitioners were, about the retroactive application of these rules dating back to their initial, codification in 2016. So if the Supreme Court comes down in 18 and says, yeah, I guess this is good, then you have to go all the way back to 16. And of course, people weren't complying with the rules back then, so everyone was going to get whacked over the head. But so here, take a look at the statute, right? South Dakota, it says 100,000 in goods and services or engage in 200 or more separate transactions in the state. If you did that, it was as if you had a physical presence. That's the way they crafted their statute. But they were fairly smart in this. They actually put a specific provision in there that said, yeah, there's not going to be any retroactive application here. This whole thing's going to be stayed pending the review of the U.S. Supreme Court. Okay, we're just running a little bit short on time. I just want to jump ahead to a couple of things that were mentioned in the opinion that I thought might be of interest to some people here. One of the things that Wayfair put on their website, right, was that one of the best things about buying through Wayfair is that we do not have to charge sales tax. That's a heck of a marketing ploy there. So of course, yeah, the brick and mortar stores right in South Dakota, they were saying, oh, we're going to get whacked here. This is another one I like. Eventually, software that is available at a reasonable cost may make it easier for small businesses to cope with these problems. Yeah, I'm not sure about that one. Because if you look out there at some of the stuff that's available, and if anybody knows, if you go back and try to figure out how you're going to become compliant in sales tax, you'll quickly figure out it's not as easy as you think. One of the comments in the dissenting opinion that I think Shawn illuminated here is, look, there's over 10,000 jurisdictions here. You're talking about state sales tax, local sales tax. How is somebody supposed to be compliant with all these things? Yeah, I think that is a good point. But nevertheless, it sort of fell on its face there. Look at some of the examples here. New Jersey knitters pay sales tax on yarn purchased for art projects, but not on yarn earmarked for sweaters. All right. Look at the Texas one, you know, the deodorant versus the deodorant with antiperspirant in it. And the Twix and the Snickers bar example, which we alluded to before, they actually put this in the opinion. So why was South Dakota's statute upheld? Well, they deemed it to be, you know, acceptable. It's not that they said, as long as you have $500 of sales here, we're going to require you to do this. When in fact they came up with a reasonable number, 100,000. That was bought by the Supreme Court. But interestingly enough, though, if you have foreign entities that are selling their product into the U.S., how can we require them to charge, collect, and remit sales tax? That remains a question that's unanswered at this time. And of course, some states, wasn't just South Dakota that enacted statutes like this, some states actually have a provision in there that their statute is to be applied retroactively. So be careful about which state you're going to go into. Okay, the last thing I'm going to talk about here is, you know, one practical implication here. There was, although I guess in light of what just happened here, I suspect maybe this doesn't get pushed through at this time, the Online Sales Simplicity and Small Business Relief Act. Well, that's a mouthful. And effectively what it says is, look, if you don't have $10 million in sales revenue in any one given year, these rules don't apply to you. So they are going to throw a bone maybe to the small business owner and say, yeah, 4, 5, 6, 7 million, yeah, you're still under the old rules. But if you jump over 10 million, why they came up with 10 million, not sure, then you are obligated to follow the enhanced rules. Of course, you can see some of the dates there, and Shawn's going to talk about some further practical implications of this.
So we talked about, you know, how obviously complex it can be in determining the taxable sales, and went on to talk about how administratively it's, you know, a lot of time, very time consuming and so forth for taxpayers to, you know, go through the compliance steps to comply in the individual states. And Mike just talked about now the states have a kind of a better chance of going in and assessing taxpayers to subject them to their tax. So a lot of questions we get asked is, you know, why go through all these headaches to try to determine what the exposure is? People may have an opinion, oh, if they find me, they find me, I'll pay the tax down the road. What we recommend is, you know, at a minimum, it's important to go through an analysis to kind of understand the exposure. At the end of the day, Mike alluded to, there's 10,000 different jurisdictions there, so it is nearly impossible to be compliant in all jurisdictions. So going through the analysis, understanding where your sales are, what the types of taxable liabilities are for a company, or taxable transactions are for a company, is important so that you can begin to understand what the potential exposure could be. Because as I mentioned earlier, remember, if the seller isn't going through the steps of collecting the tax they're supposed to, they're the ones that are on the hook for that liability, unless they can go back and get some recourse from their customers. In that situation, you want to go through, do the analysis. At the end of the day, it may come out that it's, from a cost-benefit perspective, it's not worth it to go through the compliance. But the last thing you'd want to have happen is be in a situation where it was completely ignored, and all of a sudden you have a nexus questionnaire shows up at your office, or a state auditor who shows up and starts digging around, and all of a sudden there's a significant liability out there that no one kind of had paid attention to, and obviously the economic impact of that could be significant. You know, we also say, you know, think about the big picture here. It's been a very active market with regard to mergers and acquisitions over the last year and a half. Personally, I've been involved in about 5 or 6 transactions this year alone. And what I can say is when, you know, we go through the due diligence process and the buyer brings in their teams with questions and so forth, you know, taxes are certainly going to be a part of it, and the sales and use taxes are a significant portion of it. They're coming in, the advisors that is, you know, their purpose is to come in and point out, you know, lift up the hood, look underneath, see what all type of exposure is out there, and make sure that the buyer comes in aware of that type of exposure, so that can be accounted for in the case you don't want something like that to pop up after the transaction. So they come in aggressively. They're going to come in and try to find, you know, all the different types of shortfalls that may exist. One, you know, perfect example we had was a transaction earlier this year where we had a company involved in they provided some sort of software service which we've touched on a couple of times. That's a lot of gray area with regard to software services. So the buyers team came in. It was a Big Four accounting firm. They came in, got a list of the sales. They looked at the sales and use tax reports that had been filed in the states. Looked at different types of revenue streams there were. And mind you, this was a company that had just gone through a Pennsylvania state tax audit that had very minimum changes. They operate in probably 30 to 35 different states with employees and so forth, and came back in with an analysis that showed that over the last 3-year period, which was 2014 through 2016, they estimated total exposure for uncollected sales and use tax to be about $892,000. That didn't include penalties or interest. That was just the tax liability. And then just using 2017 numbers, they said that on an annual basis going forward, they projected that tax liability to be about $366,000. So we're talking $1.2 million over a 4-year span. So we obviously got a copy of the analysis and so forth, working with the investment advisors and some of the other advisors involved in the transaction. Went in and started looking at their analysis and beating up the types of transactions they were assessing and the various different state rules. And the seller ultimately came back with their analysis that showed that instead of it being $892,000 of exposure for a 3-year period, it was only $80,000 of exposure. And the annual exposure instead of $366,000 was only $34,000. Significantly brought down what the issue was. Obviously there was some back and forth there, but ultimately the buyer got comfortable with the numbers that were presented, and obviously the seller had more information available at their fingertips that they could come back with, but it still required those steps, and it became, I want to say, a non-issue, but a much smaller issue than it had been. Another scenario, which Mike was telling me about, involved kind of a similar situation where there was a company that was acquired. They had some shortfalls. We were brought in kind of just as the seller, on the seller side, for some analysis on that, and what determined was that there was some shortfalls there, and the total liability to become compliant, counting taxes, professional fees, going through the administrative process, was somewhere just south of $1 million. So in that transaction, they actually put $1 million of the purchase price into an escrow, a contingency escrow, that was set aside so that even after the transaction, the target had to go through the steps of becoming compliant with all the different states they had a responsibility with, and then whatever money was left over eventually, which probably wasn't much, got refunded to the seller in that scenario. At the end of the day, no matter the size of it, it's a time-consuming process to go through. So the messier that taxpayers' records are when you go into a deal like that, be it 1 year down the road, be it 10 years down the road, that could be a significant delay in closing deals, which continue to close quicker and quicker as we're seeing. In addition to those kind of M&A type transactions, good times when you'd want to go through this analysis. Anytime you have an increased amount of sales or a new product into a particular state, so all of a sudden you see a particular state where you have a spike in sales, you want to make sure you have a good understanding of that state's sales and use tax rules with regard to what's taxable. A lot of times you see services and products evolving over time, so all of a sudden you're providing a service along with a product. Well, that added service alone may be considered a bundled transaction, changing the taxability of that transaction. So when that happens, it's a good time to go through that type of an analysis. Mike talked about a federal decision that affected a lot of states. So whenever there's a change in state tax rules, and it's in the area that a business may be practicing, that's an opportunity when you want to go back and make sure that you have your T's crossed and your I's dotted. And then lastly, periodic analysis is a good idea. We talked about the exemption certificates briefly earlier. Well, those generally expire, and one of the things we see when an auditor comes in, they say, well, how current are your exemption certificates? Pennsylvania statute says that their certificates are only good for 4 years. So, for companies here in PA, we recommend at a minimum, every 4 years, you've got to go through this analysis, make sure you update your sales and use tax exemption certificates so those are all current and valid, so you can fend that off upon an audit. I think Mike had a couple other kind of unique situations where he had a sales and use tax project that he's going to talk about for a couple minutes.
Yeah, so we were engaged by a nonprofit actually recently, and of course, they don't pay any income tax, but they were providing a service, okay, but they were also selling books, periodicals that they had written, hats, shirts, sweatshirts, and the analysis had to be done. Okay, well, where are you sending all these people? Where do you have a presence at? And they wanted to reconfigure their website, right, to be able to charge the correct sales tax once you popped in your address, right? Because if they had a physical presence in that state at that time, then they had to, again, charge the sales tax with first register, then charge, collect, and remit it. We were, oddly enough brought in because they got a proposal from somewhere else, and the proposal, the fee was, whatever it is, but they said, look, your sales tax exposure is, let's make up a number, 500,000. Well, they were never really considering some of the issues related to exemptions for some things, whether there was a physical presence somewhere. So we're able to actually really cut that tax down. And that really goes to, one of the points in the Wayfair decision, that there's really going to be some, cost software that's going to do all this. I mean, I find that really hard to believe. You got to have a human being in there looking at these things, breaking it down. You can't just have some computer system. They're not going to know all of the details. So that was one. We worked on that. Another one, which was, I'm a golfer, man. I really like to golf, but I didn't really know the intricacies around how, the pro shop at a country club worked. The pro, right, he or she purchases the product in the pro shop and then sells it to you as the consumer. Well, they own, the pair of golf shoes in there. So they buy them for 90, sell them for 100. They're supposed to charge you sales tax. Well, the club was charging the sales tax, but there was a disconnect between, was the sales tax actually being remitted? So, we worked in that space as well. Okay, determining whether this was a taxable event in the first place and then trying to become compliant going backwards and moving forward. Okay, we have another one that's ongoing right now. Someone had reached out to us, to effectively reassess what they've done going back to almost, the beginning of time and prospectively in light of the rules changing. So if you're out there thinking about these things, think to yourself, okay, the rules are in fact changing. If we want to be compliant going backwards, we're talking about one set of rules. If we want to be compliant going forward, we're talking about a different set of rules. I was just at a presentation the other day, a week or so ago, where someone was talking about this, and they said, well, when you think about how you're going to go into a state, and we're going to talk about this, voluntarily disclose the fact that you have a sales tax obligation that you haven't met, you should consider now whether that state is going to retroactively apply their rules, because you might be looking at a significant amount of jurisdictions and a significant amount of sales tax that you are going to be required to remit. And as a result of that, you might want to assess, whether you're going to go into a state or whether you're going to roll the dice and see, whether someone's going to discover you or not. And oftentimes that's the big thing, right? What's the audit detection risk? In a lot of cases, it's very low, and that is part of the assessment. Okay, the last one I'll just briefly talk about, because it does relate to the VDA programs, was in the example that Shawn pointed out. About 3 years ago, we were engaged to help someone in a buy-sell situation, and there was $1 million of escrow set aside. Okay, they wanted us to go back and file voluntary disclosure in a number of states. So I did that in about 10 of them. That was about 3 years ago. This whole thing was just cleaned up about 6 months ago. Okay, so it's going to take, it can take a significant amount of time. One of the differences that I'll point out is that in Connecticut, there was an online application, and you self-assessed the tax and remitted the payment, all when you filled out the application, and that was completed in about 15 minutes. New York, I mailed them in the letter. They got back to me a year later, and then it took 1.5 years to clean it up. And that was the one that took 2.5 years. So you're talking about a very wide range in order to become compliant. So as Shawn alluded to, really think about, okay, if I don't do this, how significant of a cost is it going to be to me in the future to try to clean this up if I'm looking to sell my company?
So if you've gone through the analysis and determined that you have a filing responsibility, if it's just forward-looking, like something recently, generally it's not as challenging. You can go through the general steps of registering with the state, register an account, and start to collect and remit. And most that's done electronically these days. However, if you're in a situation where you've gone through and done the analysis and determined that you have an issue that dates back many years or decades, whatever it may be, there's a couple options out there that Mike touched on to limit some of the exposure that's there. First one we'll talk about are the voluntary disclosure programs. These are seen much more regularly amongst the states and are kind of ongoing or seem to pop up every couple years. What these programs allow is for taxpayers to come forward on an anonymous basis. So generally they can go through their advisors to contact the state and say, hey, we've identified a situation where we have a taxpayer that we feel has a tax filing obligation for sales tax. And these apply for other types of taxes too, but we see it for sales tax a lot. You present the person at the state with some of the basic information, the type of business they have, the type of transaction they're performing, a basis for the liability to be determined, and they come back and they'll approve it on a tentative basis. And I say tentative basis because you do have to be unknown to the state to go through these programs. You can't try to trick through, like get a nexus questionnaire one day and try to come in through anonymously the next day. If you're already on the radar for some reason, that kicks you out of this type of program. But if you do come forward under this scenario, the two major benefits are you get to limit the amount of years that you go back, that the state can go back and file a tax return. So even if you maybe determine that you owe taxes dating back 10 years, generally these programs only make you go back 3 or 4 years. So you file the last 3 or 4 year returns through the program, pay the tax, and you're deemed to be clean going forward. They can't go back after that and say, oh, we changed our mind. You had a big sales year back in 2002, we want to get that. You're protected that way. In addition to that, it offers penalty and interest relief. Generally, the penalty can be reduced or eliminated, as well as the interest gets cut down as well. Another similar program are called amnesty programs, and these are offered much less frequently. They're generally only offered for a very short period of time, maybe a few months, up to 5 or 6 months. They generally get offered by states when they're looking to have a cash infusion into the state coffers. They come out with pretty specific requirements for taxpayers that will qualify for the amnesty program, but it works similar to the amnesty where you follow the requirements, you file the unfiled tax returns, and through this you generally can get even more relief. A lot of times they'll completely eliminate the penalty, sometimes even the interest, and maybe even cut the tax liability down. Pennsylvania last went through an amnesty program back in 2017, so it just wrapped up about a year ago. They generated $150 million of revenue through this. Prior to this, I think the last one was in 2010, so it was some years ago. I will say the 2017 campaign was quite painful. The reason I say that is because what the state did is they issued notices to all taxpayers in PA and businesses that they thought may qualify. So essentially, if their system thought that you had an unfiled tax return or liability, they sent out notices. We saw probably hundreds of these types of notices come out because the issue was the state had also just upgraded their computer system recently. So there was a lot of bad data in the system that came out. We had taxpayers getting notices looking for returns back in 1920s and 1930s. It was just ridiculous. And I think Don actually went to Harrisburg and kind of with a lobbying campaign and kind of expressed our frustration with that process, but it was painful. So we talked a lot about sales and use tax. We only have a couple minutes left. So Bob and Don spent about 2 hours this morning talking about the Tax Cuts and Jobs Act. So we just wanted to mention it briefly that while we think that there's a significant, obviously, tidal wave coming for federal taxes from a state tax perspective, it's probably not going to be as significant. States generally will conform to Internal Revenue Code in a variety of different ways. Here in Pennsylvania, it's the last one called specific reference. So they'll only conform to specific parts of the Internal Revenue Code, and it takes a policy change or law change to pick up a lot of the new changes that came out with the federal tax bill. So the QBI deduction I talked about this morning, we think that's unlikely. You're going to see that benefit in a lot of states. What could be the impact there, though, is through a lot of the analysis we'll be doing for federal purposes, it looks like, because itemized deductions are being limited or eliminated, we're going to see federal taxable income bases actually go up, even though at the end of the day, the federal tax liability comes down because the rates are lower and so forth. Well, the state rates didn't really change with the reform. So what's going to happen is all the states that have their starting point is your federal taxable income, all of a sudden the state tax base is going to be higher if they follow federal, and they're going to be applying the same tax rate they did in prior years. So that's going to have a kind of a unintended impact maybe from a state tax perspective. Probably not significant, but wanted to mention it nonetheless. Lastly, just mention we didn't get a chance to cover some of these current events that happened in Pennsylvania. Over the past year, there were 5 developments, nothing too earth-shattering. The first 2 covered C corporations primarily. We do issue newsletters on this on our website, so hopefully you're checking our website frequently under the, I think it's the Insights section, where we'll send out these newsletters to give information and so forth. But with that, we have about 18 seconds left, so I think we hit our time. Thank you for your time today. You paid much more attention to my Kit Kat discussion than my son did when I tried to explain sales tax to him. So I appreciate that. So.